Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Sovereign gold bonds are RBI mandated certificates issued against grams of gold, allowing individuals to invest in gold without the strain of safekeeping their physical assets. Sovereign gold bonds are also one of the most beneficial ways to invest in gold as an asset. And with Akshaya Tritiya approaching, it makes for a perfect time and to understand how sovereign gold bond works and what are the rules for premature redemptions and how it is taxed. Let's understand all of these aspects with Harshvardhan Roongta, CFP, Roongta Securities. Harsh, good evening. Welcome to the show. We are talking about sovereign gold bonds and also talking about Akshaya Tritiya, which is around this weekend. So let's just focus on a premature withdrawal because this is something that's not talked about much. Although there is 8 years lock-in, but then can one have a premature withdrawal from sovereign gold bonds?
Yes, Kavita. So sovereign gold bonds are, as you said, the tenure of the bond is 8 years. So if an individual invests into it, they have to hold on till 8 years. Now, in case somebody wants to prematurely redeem or wants to sell off, partly or fully, these bonds are listed on stock exchanges. So you will have to essentially go on the exchange and find a buyer for your bonds on the exchange. So if you're owning, say, probably 100 grams of gold, and in case you want to redeem or you want to sell only 5 grams, that is possible. However, you will have to do this on the stock exchange platform. So you will be able to buy, you will be able to find a buyer there and you can sell, but not necessarily the buyer may give you the price of gold as it is on that day. So there could be a discount or a premium as it may be. Usually the bonds that sell on the exchanges are at a discount for a simple reason. It's kind of an illiquid kind of a investment in that sense. So a buyer would want to take it at a lesser price. Now, in case you want to give it back after 5 years, so first 5 years, the only way of redeeming them is through a stock exchange mechanism. However, post 5 years and before 8 years, in case you want to give it back, you want to sell or redeem, you have an option to give it back to the RBI on those same dates on which the annual on which the semi-annual interest is paid. So interest on the sovereign gold bond is paid every 6 months. So on the date of that payment, you can give back your bonds to RBI, and they will pay back the amount which is equivalent to the price of gold on that day. So there is a liquidity available. As I said, prior to 5 years, it is only on the exchange. Post 5 years and before maturity, which is 8 years, you can give it half yearly back to RBI and you get the price of gold on that day.
And how are we taxed for premature withdrawals?
Well, there are two elements to this. So first, of course, if you hold on, so let me just highlight that part. If you hold on to those bonds until maturity, which is 8 years, all the gains that you make on that investment is tax exempt. So there is no tax that you have to pay only in one case that you're holding it till maturity. So there's no long-term capital gain that you have to pay on this investment. However, if you withdraw before 8 years, which is premature withdrawal that you're talking about, if you hold it for 3 years and you sell it before 3 years, then there is a short-term capital gains and it is taxed as per your income slab. So whatever is your income tax slab, you will be charged tax on that when the holding period is less than 3 years. So all the gains that you make will be short-term capital gain. And as I said, this transaction will take place only on the stock exchange. Now, in case of holding period more than 3 years and up before 8 years, which is before maturity, then it is a long-term capital gain and the taxation will be 10% with indexation benefit.
All right. One last question on SGB, and then we move on to our viewer queries. Harsh, now looking at Akshaya Tritiya coming on the weekend, it won't be possible for people to buy ETFs maybe online if at all they want to. However, do you recommend SGB and any tranche that's going to come up, or they can just buy it via exchanges now?
See, no, Kavita, essentially you will have to understand the RBI will come out with a calendar for the new issuances. So if there is a calendar, then you can most certainly invest into it through that new tranche. If not, then of course you will have to take it from the exchange, and most likely you would also get it at a discount when you take it from the exchange. So there is no harm in trying to buy an issue which is already in existence from the exchange. And just one correction, I just mention capital gains tax at 10%? I guess I did that, but just one correction there. Long-term capital gains, if your holding period is more than 3 years, would be 20% with indexation, not 10%. I guess I said 10% earlier.
Alright, so that's a clarity on that. But then let's move on to our viewers and viewers' queries. We have Mani's question for you, and he wants a corpus of 10 crores in 15 years. He is doing an SIP of 46,000, UTI Nifty 50, Nippon Small Cap, Canara Robeco Small Cap, Kotak Emerging Equity. He also has Nippon India Large Cap in his portfolio. So, what is the uh, portfolio value right now? Is 11 lakh. That's what is given to us. So, what do you suggest?
Well, Kavita, the target is very aggressive for an investment of 46,000 per month and an accumulated corpus of 11 lakh. In 15 years, looking at 10 crores, which is very, very aggressive. I guess even if I looked at a 12 to 14% kind of a return explanation, you can expect about 3.5 crores. So 10 crores is very, very aggressive. Now, coming to his portfolio, there is just one suggestion I'd like to give that in place of the Nippon India large cap, he can opt for a flexi cap fund because he already has a UTI Nifty 50, which is again a large cap index fund. So in place of an active large cap, he can opt in for a flexi cap, which will also be large cap biased. However, there will be an option to add multi cap, the mid and the small cap if the fund manager feels so. So that is just one, and the scheme name, if he wants, it could be Parag Parikh Flexi Cap is one thing that he could add. The rest of the schemes look fine.
All right, we move on to our next question. C. Shankar Nath, and he's a retired technical officer. He wants to invest 20 lakhs in mutual funds, and he wants some fund suggestion for this purpose. We don't have him on the phone line, or else we could have asked him more details. But 20 lakhs in mutual funds, and he's retired.
Uh, yeah, so Kavita, the information that he's provided is very less. I mean, we cannot just simply look at that. You want to invest 20 lakhs in a mutual fund. I'm retired, so let's give me some options. What I suggest him that retirement is a life changing event. So you cannot just take decisions such as I want to invest 20 lakhs in mutual funds. Please suggest some scheme. You really need to know why are you investing. What's your risk profile? What's your time horizon? Whether you're looking at regular income out of this investment or not. So there are lots of things that go into deciding where this money will go. We don't even know whether he's looking to invest into debt funds, equity funds, or hybrid funds. We don't even know that. So I wouldn't recommend any scheme without knowing all the other information that we want. And I'd also very sincerely request him to go and personally meet a professional with whom they can discuss all these details and then plan out something which is very specific to his risk profile, to his requirements. I think that would be a better way of going about it.
All right, next question, Pradeep. He's been investing in mutual fund since last 2 years, and he's managed a corpus of 1.5 lakh. He's holding Nippon India Small Cap, EGI Mid Cap Opportunity, Parag Parikh Flexi Cap, and he wants to understand if he can hold these funds, and he's looking at least 15% return from these funds.
Yeah, as far as the schemes go, Kavita, I think all the schemes are fine. So he's got one large cap oriented flexi cap fund, large cap biased flexi cap fund. He has a mid cap and a small cap. So I think he's got good schemes into the respective categories. So there need not be any changes there. However, we don't know the amount that he's investing in each scheme. So how he's got allocations between different categories. I suggest that he should also look at investing a particular amount, the allocation. How is he divided between all three schemes? I'm not aware. So probably you might want to put some mind into that and also decide how much should go into a large cap, how much in mid cap, and how much in small caps. It can't just be all equal. It could be something that he may want to have a large cap, more investment in large cap, lesser in mid, and even lesser in small. So just look at that element and rebalance if required. Otherwise, all the schemes are fine.
All right, I think that will be all for today. Thank you so much, Harsh, being on the show and helping our viewers with their financial portfolio. And time for me to sign off. I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.